Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Netflix's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Netflix is a subscription-based streaming service that allows members to watch TV shows and movies without commercials. The company is headquartered in Los Gatos, California, and was founded in 1997. It went public in 2002 and currently trades on the NASDAQ. It has 204 million subscribers, with 73 million of those in the United States. Its initial business model included DVD sales and rental by mail, but it abandoned the sales after a year to focus on the rental business. It expanded its business in 2007 with the introduction of streaming media, while retaining the rental business. The company expanded internationally in 2010, with streaming available in Canada, followed by Latin America and the Caribbean. Netflix entered the content production industry in 2013. Its first show was House of Cards. It releases more original content than any other network or cable channel. In 2000, Netflix relied on the US Postal Service for the delivery of their DVDs. Their losses would total $57 million, and they offered to be acquired by Blockbuster for $50 million. They proposed that Netflix would be renamed Blockbuster.com and would handle the online business, while Blockbuster would take care of the DVDs, making them less dependent on the US Postal Service. Blockbuster declined the offer. Let's get started with the model. This is a large cap company, 241 billion market cap. They're trading at $5.46 a share, and they have 442 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had negative free cash flow in 2017, 18, and 19, but they finally had positive in 2020. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that's positive every year and growing quite a bit, from 500 million to 2.7 billion. Revenue is a sales for the company, and that looks amazing, growing from 11 billion to 25 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference is the gross profit. And their gross profit more than doubled from 2017 to 2020. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income. Their operating income almost doubles every year. Below that is the interest they pay in their debt. They paid $1.4 billion of interest in 2020. They paid $600 million in 2019, so they're taking on a lot of debt to acquire content. Below that is pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is positive and growing every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses on its operational business. They had their first positive operating cash flow year in 2020, $2.4 billion. Before that, it was negative. It was nearly negative $3 billion in 2019. Then you have capital expenditures, which are investments in property, plant, and equipment. They had their highest CapEx year in 2020, $500 million. Operating cash flow minus CapEx give you your free cash flow. And they had positive free cash flow in 2020, negative in prior years. You can see they issue a lot of debt. They issued $3 billion in 2017, $4 billion, $4.5 billion, then $1 billion. In order for Netflix to show certain movies or TV shows, they have to pay the creators a fee. Those fees can be really expensive. Netflix is creating content on its own, so that's also expensive. That's why they're taking a lot of debt to run their business. They're also issuing capital stock. They issued 88 million in 2017, 120 million, 70 million, 235 million. When a company issues capital stock, that increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. $11 billion of equity, $16 billion of debt. They're 40% equity, 60% debt. Their net debt is $8 billion, and their WACC is 8.3%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 172 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $143 billion. We divide that by 442 million shares. And we get a calculated stock price of $325. They're trading at $546, so they're trading at a 68% premium. It's a sell according to the model. Simply Wall Street is a lot higher than me. They're at $513 a share, so they're saying the stock is overvalued, just not as much as me. 31 analysts priced this stock in the past 3 months. The average target was 618. The low was 340, which is pretty close to where I am, and the high was 750. Just because a stock is overvalued doesn't mean it can't go up in price. I still think Netflix stock will go up in price because so many people are interested in this stock and a lot of people buying it, pushing the price higher. This is the stock price the last 5 years, so it's pretty much only gone up. It did take a little dip here and there, but overall it goes up over time. They have a pretty low beta, 0.79, so the stock is not volatile. It moves less than the market. The stock has gone up 25% in the past 52 weeks, while the S&P 500 went up 48%. The 52-week low was 393, the high was 593, and the stock is trading above its 50-day and 200-day moving average. About 3 to 4.5 million shares are traded each day on this stock. Of the 442 million shares outstanding, 437 million are on float, 82% are held by institutions, and 2% of the shares are shorted. In the past year, the stock has gone up 29%, while its industry went up 70% and the market 56%. But in the past 5 years, this stock has gone up 470%, while its industry 170 and the market 120. Analysts are forecasting their earnings to grow 25%, while its industry 35% and the market 18%. Analysts are forecasting their revenue to grow 14%, its industry 15%, and the market 9%. In the past 5 years, their earnings grew 52% annually, their industry 39%, and the market 12%. In the past year, their earnings grew 48%, its industry 53%, and the market 4%. If you invested $10,000 into this company 10 years ago, you'd have $158,000 today. That's a 32% annual return. The biggest shareholder is Capital Research at 13.5%, then Vanguard, BlackRock, T. Rowe Price, and FMR. Let's look at their financial ratios. The average PE in the market is 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 87.4, so investors are paying $87 for $1 of earnings. Their price to sales is 9.7, which is worse than the average. Their price to book is 21.8, which is also worse than the median and average. Price to book is stock price over book value per share. To calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $11 billion of equity, negative $14 billion of tangible equity, since they have $25 billion of other intangible assets on their balance sheet. Their return on invested capital is 20%, and their WACC is 8%, so their excess return is 12%. They're making money hand over fist. Their interest coverage ratio is 3.3, so they can cover their interest payments more than 3 times. ROE is 25%. That's a great ROE. Their current ratio is 1.3. So they can cover their current liabilities with their current assets. Their current assets are mainly cash of $8 billion. The company does seem to be well capitalized. They had $1.9 billion of free cash flow and $1.9 billion of working capital. So they have $3.9 billion of funding. So they may be able to get through the next year without taking on any more debt. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on AMC, Cineplex, Disney, Discovery, Genius, and Roku, all in the same industry as Netflix. And if Netflix has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in PE. The average is 43. They're 87. They're better in price to sales, price to book, current ratio. They have a great ROE. Most of their competitors have a negative ROE because they have negative earnings. They are a little lower than average in debt. And they're the second biggest company on this list. Disney is the biggest. And nobody pays a dividend in this industry. So to summarize, I have them trading at a 68% premium. But I think this is a great long-term hold, because there is so much demand for their products that people are going to buy the stock no matter how inflated it is. So it's going to go up over time. It may drop a little bit when there's a crash, but everything drops then. It's a great company. They have tons of subscribers, and they're number one in their market. I rank their free cash flow 8 out of 10, their revenue 9 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.